All right, let's talk about one of the most popular strategies out there for making a little extra income from the stocks you already own. We're diving deep into the covered call.
So I want to kick things off with a question, especially for anyone out there who owns stocks. What if those shares, the ones just sitting in your brokerage account, could actually pay you, like a tenant paying you rent, month after month? Well, that's exactly the idea we're going to unpack today. But, there's no free lunch. With any strategy, there's always a trade-off. A covered call is really about a bargain you're making with the market. You get paid cash right here, right now. But in exchange for that cash, you agree to sell your stock if it goes above a certain price. And that means you're capping your potential profit.
So what is it, technically speaking? Well, a covered call is when you sell something called a call option. That's just a contract that gives someone else the right to buy your stock from you at a set price. For selling that contract, you get paid an upfront fee, and that's called a premium. The word covered here is key. It simply means you actually own the shares you're promising to sell. You've got them covered.
Sticking with our rent analogy, that cash you get up front, the premium, that's your rent check. So what are you renting out exactly? You're renting out your stock's potential to just shoot for the moon. You're giving up the gains beyond a certain point.
Okay, theory is one thing, but let's make this really concrete. We're going to walk through the anatomy of a trade piece by piece so you can see exactly how this works.
Okay, so let's imagine you own 100 shares of a stock, and it's currently trading at $50 a share. You decide to sell one call option contract, and remember, one contract equals 100 shares, with a strike price of $52. That strike price is the price you're agreeing to sell at. Let's say it expires in 1 month. Just for making this deal, you immediately get paid a premium of, say, $3 a share. That's $300 total in cash that goes right into your account.
So you've made the trade, you've pocketed your $300, and now you wait. Once that month is up, there are basically 3 ways this can all play out, and it all comes down to where the stock's price lands.
First up, let's say the stock price drops to $45. Ouch. If you were just holding the stock, you'd be looking at a $500 loss. But because you did the covered call, you still have that $300 premium you collected. So yeah, you still lost money, but the premium acts like a cushion. Your loss is only $200 instead of $500.
And that right there, that perfectly illustrates one of the main benefits. That $300 premium is your buffer. Now, it's not going to save you if the stock completely crashes, but it provides a nice little cushion that can reduce your losses if the market goes down or just chops sideways.
Okay, now what if the stock does the opposite and absolutely soars to $55? This is where that trade-off we talked about really kicks in. Because the stock price is above your $52 strike price, your shares get called away. That means you have to sell them for $52 each. Your total profit here is the $2 per share gain from 50 to 52, plus that $3 per share premium you got. So you still made $500, which is great, but you did miss out on that extra climb from 52 to 55.
And this is the single biggest risk of the strategy. It has a name, opportunity cost. You're getting paid up front for taking on the risk that the stock might just have a monster rally. And if it does, you're going to have to watch those extra gains pass you by.
And finally, we have the Goldilocks scenario, the one that's just right. Let's say the stock price goes up, but it finishes just below your strike price, say at $51. Well, in this case, the option you sold expires completely worthless. The buyer won't use it, so you get to keep your shares, which are now worth more than when you started, and you keep the full $300 premium. Your total gain is $400, which actually beats the person who just held the stock. This right here is the sweet spot.
Setting up the trade is actually the easy part. The real skill comes in knowing how to manage it as that expiration date starts to creep up on you. So let's look at what you can do.
The clock is ticking. Your option is about to expire. What's your move? Well, you've actually got a few different choices. As you get close to the end, you've got 4 main paths. 1, you can just let it expire worthless. That happens if the stock is below the strike. 2, you can get assigned, meaning your shares get sold. 3, you can actually close the trade early by buying back the same option you sold. Or 4, and this is a popular one, you can roll the position, which just means you close your current option and open a new one for a future month, collecting even more premium. And this is just so important. Don't just take it from me. As the experts at Options Trading IQ say, managing the exit is way harder than the entry. The absolute key takeaway here is to have a plan before you even hit the trade button. Know exactly what you're going to do in every possible scenario.
Okay, so we've spent a lot of time on how this all works, but to be responsible, we have to talk about the flip side, the risks and the common mistakes that can really trip people up.
So we've hammered on opportunity cost, but the other two risks are just as critical. First, you've got to remember you still own the stock. If it tanks, that little premium isn't going to save you from a huge loss. And then there's assignment risk. You could be forced to sell shares that you really wanted to hold for the long term, and that could even create a surprise tax bill for you.
And please, try to avoid these common mistakes. A big one is selling a call right before something volatile, like an earnings report. The stock can make a massive, unpredictable jump in either direction. Also, don't just chase after the highest premiums you can find. A really high premium is the market's way of telling you it expects a storm. And finally, you have to know your break-even price. That's just your stock's cost minus the premium you got. If the stock falls below that number, you're officially losing money on the whole position. You know, this chart really tells the whole story in one picture. The green line here is a covered call strategy, and the black line is just a regular index, like the S&P 500. You can see how the green line is, well, smoother. It's less jagged. It doesn't hit those incredible peaks when the market is roaring, but it helps cushion the blows during downturns and just keeps generating income when the market is flat. That's the trade-off, visualized.
And that brings us to the final question you really have to ask yourself. Is a strategy like this right for you? It really all comes down to your personal goals. Are you willing to trade the chance for a massive home run for the potential to hit a steady stream of singles and doubles? There's really no right or wrong answer here. But understanding that trade-off is absolutely the key to making the right choice for your portfolio.